So you probably saw it in the last 1 or 2 years. Most German media, they warned about property prices collapsing. Today we're going to talk about what really happened and what the state of the 2025 real estate industry actually is. So when you look at the industry, we actually kind of concluded that while the housing market is under pressure, there are a lot of strong fundamentals that are backing it up. And that's also what kind of confused a lot of people who expected prices to collapse and the reason why they've remained so high, especially in certain segments. So one of the most important drivers for property prices is actually population growth. And here we see two important graphs. The first is the population evolution of Berlin, Germany, and the different so-called A cities. And then on the right, you see the GDP per capita in euros. From these two graphs, you can talk about this for an hour, but what they show is that the top 7 German cities are really strong in terms of GDP per capita. What we also have seen is a growing trend. A lot of this, as you probably know, has been related to immigration in the last 10 years especially. But what we see especially is that the 7 cities are growing faster than Germany as a whole. Now, why is the GDP per capita in Berlin a little bit lower on average? Well, that's on two parts. The first is that the average age is actually lower than Germany as a whole. So I think it's about 42 years old versus 44 on average. And the second is when you look at the distribution of people, you have a large segment of students. Students are, of course, not earning or not producing and adding to the GDP per capita. Now, when we look at the population as a whole, obviously more people equals more demand for real estate. But one thing that a lot of people tend to overlook is what is the actual composition of the population. And what Chris and I, so Chris is my dad, is a former economist, what we looked at and what we studied was the average household size. And you can actually see that in this table really well, that in 2000 you had an average household size of 2.1, and in 2023 you had an average household size of 2.029. It doesn't sound like a lot, but that decrease of 0.28% annually since 2000 actually leads to a housing demand of 115,000 units, which is quite enormous in the fact that just in terms of shrinking households that we need to add 115,000 apartments per year. That's one. The second is that an aging population, typically what you see in cities where when you have a really tight housing market, you're in your 70s and you have a large apartment, maybe one person dies, what happens is then you hold on to that apartment because there is simply no alternative. So the apartments are then, the space is then concentrated among an elderly demographic. The third point, which is very critical, which we've been studying, is that there's a shortage of skilled workers in Germany. So you all know how when it comes to technology and skilled labor, there's obviously a huge disparity between what you call, let's say, immigrants and then what you have called as skilled workers. So skilled workers are, for example, STEM graduates or people who are specialized in medicine or sciences or engineering. And what we see is that 50% in 2022, and it's slightly a little bit lower, of the overall share of the companies feel that there is a shortage. When you ask the labor market experts, they estimate that we need about 400,000 foreigners just to close the skill gap. So there's clearly a big problem between supply and demand when it comes to labor. And I think that's one thing that is often overlooked, that, on the one hand, you might have certain political parties which are immigration, but on the other hand, you have a clear fundamental need in Germany for skilled workers. And that's something that we use also as a fundamental argument for future prices being held up higher. So as you see on the left, there's something called what we call apartments per 1,000 inhabitants. So again, you have the three same colors. You have Berlin, you have Germany, and you have all cities. Now, what's quite interesting is that Berlin actually had an oversupply in the early 2000s. This was especially after the reunification. You saw a lot of houses and a lot of apartments being built. Now, so they come from a higher amount of apartments per 1,000 inhabitants, and now what we see is that we're actually much lower. So what we see in general is that the supply of apartments per person has been shrinking. Now, that wouldn't be a problem if there was enough housing being built. So in the end, this is about the supply of housing in Germany, but also in Berlin as a whole. And what we see is that there's a growing housing deficit. So not enough is being built on an annual basis to keep up with this demand. So when we talk about the demand of 115,000 apartments that are just needed based on an aging and a shrinking population, then you have the demand requirement for skilled labor. And then at the same time, you have the actual number of housing units that are being produced on an annual basis. So this graph shows the number of building permits. This is translated to about 90% are successfully completed. On an annual basis, we're looking at about 200 to 220,000 units per year that are being created. So far, this has led to a 500K deficit, and we'll look in a little bit what the forecasts show. You see it here, Andreas Mattner, so he's president of the German Property Federation. He said that we're in for a very bad awakening. This is something you can already see in the cities where rents are increasing. Last year, Berlin alone, 12%. What's most important though is here the last line. An earlier outlook put the shortfall already at 830,000 houses by 2027. Now, when you understand the supply and the demand issue, clearly we have an over-demand and an undersupply. So I started off by saying what actually happened to the property prices. Well, here you have them. Europace is one of the main mortgage platforms. They are basically looking at the transaction prices, and they run one of the best indexes for property prices. Here you see three lines. Apartments, new build, and existing houses. One thing that was very interesting was that in 2022, after the Russian invasion, we saw a divergence. The yellow line kept going up, the green line went down, and the gray line went even further down. Now, we'll look at that in a second, but what especially is interesting is that the yellow line continued. And this is due to what we then saw as major inflation in a lot of the different construction materials. So for example, cement increased by 60%. So logically, when the building permits are declining, why? Because the costs are going up. This housing shortage is only going to increase. When you then look at the fact that the existing properties are then being discounted even more than the new builds, you see kind of this demand shift towards higher energy efficiency. And this is quite interesting, and we'll look at this in the next slide. This is one more slide showing again the high construction costs that we experienced, especially in 2023. It started in end of 2022, but only in 2023 did it really explode, and now it's flattening a little bit. So again, construction costs are way too high, And this is also what is keeping these property prices up so much. Now, I mentioned something about the new build properties. Here you see two interesting graphs. One is the price reduction compared to final energy efficiency class A+. And so what you see is the best energy efficiency on the left and the worst energy efficiency on the end, which is H. And then you see it between a flat and you see it between a two-family house. Now, what you can observe quite easily is that, first of all, the family houses, so Mehrfamilienhaus or Einzelhaus, are basically decreasing or have been written, let's call it discounted, at a higher price. So some of these houses are 20% lower than their peak in 2023 compared to an energy efficiency class of A+. So A+ is 0, A is already minus 10% for a two-family house and minus 5%. So what it shows is that consumers are pricing in energy efficiency. And the energy efficient properties have recovered much faster as well. And you see this again with this divergence on the right between the different property prices per energy class. So we've kind of talked a little bit about Germany as a whole. Now we're going to talk a little bit more about Berlin in particular and what we can conclude about some of the graphs and some of the numbers that we've been looking at. So, don't need to read it out loud, but I can translate it. So clearly a shortage pushing rents up. As I mentioned before, there's a 12.5% increase last year alone. So this is something that clearly is showing first in the rental market and then in the seller's market. So clearly, property shortage, housing shortage is driving an increase in the rents. So we see on the left, we see the forecast when it comes to number of households in Berlin specifically. So the population of Berlin is about 3.9, moving closer to 4 million. It's growing faster than any other city. Here we have a forecast till 45. What might be, so it could either be there or it could be there, but obviously most likely is somewhere in the middle. Then on the right hand you see the rental prices for rented apartments in square meter. And you see again that new construction has always been a little bit above all construction. Now, this has especially increased recently, and it should be increasing a little bit more. But what you see is that new build apartments are uncapped when it comes to the rental caps. Now, keep in mind, Berlin has 85% of the population is renting. And you do see a lot of internal migration within Berlin and the borders around it, which we'll talk about in a second. Now, a very good metric to study the local Berlin market is what we call the vacancy rate. So the vacancy rate is what percentage of the properties listed are actually vacant. Now, I know there's a lot of theories about properties being empty in Berlin, but unfortunately, or rather fortunately, that is not the case. Again, similar to what we saw in the earlier data, when we look at 2000, 2005, we actually see a higher vacancy rate, the highest in Germany in this case. And now what we see is we actually have the lowest vacancy rate. So again, this is due to this explosive growth and also the high uptake in demand. Also quite interesting is, again, when we look at the supply and demand, well, in Berlin, we actually have the highest need for new apartments. This is, of course, also because Berlin is more people than the other cities, but just generally speaking, Berlin needs about 23,000 new apartments every year just to meet the demand. And what we're seeing is we're building on the order of 14,000, 15,000. So here too, just like in Germany, in Berlin specifically, we're really struggling to keep up with the demand. Now, when you zoom out a little bit and you look at Berlin prices compared to Geneva, London, basically any of the main key cities in Europe, Amsterdam, Frankfurt even, Vienna, Hamburg, Copenhagen, you see that the average square meter price, and when we say average, we also take existing properties, but also outside, not just the ring, but outside, and you're looking at an average of 5.8, if I'm not mistaken. So what we're seeing is that wages are catching up to other European cities. So if you're an engineer, you probably know that the difference between working in Berlin, London, and Paris is quite small. But when you look at the property prices, in Paris, for example, you're looking at prices around 10,000, 11,000, and in the very city center, you're looking at 13,000 easily. Now, of course, in Berlin as well, if you're looking in Mitte, like Mitte, you're also on the order of 10,000. So, what have we been observing? Well, we've observed something called the Berlin ripple effect. And this is something that also is in line with kind of what we've been talking about a lot at InvestFriend is obviously the demand inside of Berlin is too high and it's pushing people out. And so this kind of gentrification, if you want to call it, but also this undersupply of properties has forced people to look outside of Berlin's closest borders. And the result has been an outflow to Brandenburg. And so we see three main points. We see an urban overflow and a quality of life shift. We see infrastructure improvements. And lastly, we see higher yields and lower entry prices. So, EmoScout actually published some very interesting data. This is about the requests. So the requests mean landlord or owner puts a property online, and then based on the number of requests they look at where that demand is shifting. So what you see on the left is that basically the share between the main city and the outer edge, and then let's say the actual countryside, has been shifting in favor of what they call the Speckgürtel. So like the speck is the fat around the city, right? So it's kind of in this graph you can see it very well. You have this is based on kilometers away, so you have 15, 30, 50, 75, and 100. And so what you see here is that this green bar started in 2019, 32% of all requests were for the Speckgürtel, and now it's increased to almost 42%. Quite interesting. At the same time, you have, when you look at the rental price development, you have an increase from 11.25 to 12.64, whereas in the actual city center itself, you have 16.59 to 17 euros 29. So on a pure absolute and relative basis, it's actually less, slightly less, if I'm not mistaken. What this shows is that the outer areas of Berlin are developing at the same pace, if not faster. And why that is because, well, obviously after 2022, after COVID, we saw a big development in kind of this whole remote work and the possibility to work from home. And this has led a lot of people, many friends included, to either move out or to consider moving out. And this is something that we've been seeing and has been supported as well by this data. Of course, when we look at the infrastructure improvements, people only move when the infrastructure is there to move. So infrastructure implies not only schools, kitas, but also transportation. And when we look at the areas that we've been on the scout for, let's say, new builds, whether that's Sossen or Teltow, so Teltow is here, Sossen is here, what we always look at is whether the infrastructure is well developed and how long it takes to get to the city center. Why? The main hypothesis is, of course, that people will still work in Berlin but many times because they can work remotely, they can stay in the periphery. Now, one thing that's not so well known is that both Schönefeld and Zussen have the lowest trade taxes in Germany. And so what that means is it's very attractive for businesses like mine to have an office there. So that's actually attracting a lot of business. A lot of people have either holding companies or their main businesses there. Why? Because it simply is quite attractive on a taxation perspective. Okay. Now, when it comes to real estate investment, and we'll get into the details in a little bit, but from an investor perspective, not only do we now look at the new cap for special depreciation, which we'll explain in a little bit, but we also want to look at where land is cheap. And so on the right side, you see the price per square meter of land. So in Berlin, you're looking at sometimes 4,300 average, if I'm not mistaken, 4,200, sorry. Munich, it's 4,800, Stuttgart, 2,000, Frankfurt, 5,000. Whereas you then have the light blue areas where, for example, in Teltow it's 600 and in Sulzen it's 125. Now, if you have the same construction and you build it in two different places, now obviously the one with the cheaper land will be cheaper overall. And why that's important is because the special depreciation cap has put a cap on the total price being under 5,200 euros. And that basically means that in order for projects to be eligible for special depreciation, Germany has kind of subsidized the affordable housing in certain areas. Because logically, if you're in Berlin and you buy the land for 4,000 euros, you can't build it and sell it for 1,200. Now that's quite interesting, but the opportunity for investors is also to look at the rental yield. So when the new build rents are 22 euros in Berlin and still 19, 20 euros in Teltow, but you buy land for a third or a fourth of the price, that's quite an interesting deal for the investor, so that we don't need to explain so much. So that's kind of wrapped up let's say the Germany, Berlin, Brandenburg discussion. And so now I want to focus a little bit more on what's happened in 2024, and obviously it's 2025, but what specifically happened in 2024 and why that's interesting for real estate investors. And then the ultimate question of own use versus buy to let, because that's something we obviously get a lot. So let's start with the new depreciation laws. So what changed in 2024? You most likely know the concept of depreciation. So depreciation is the notion that an asset is decreasing in value. From an accounting perspective, you can basically take this cost, this decrease in value, and you can write it off. Now, in real estate, that concept has existed for quite a while. But the difference is that in 2024, they basically took this depreciation rate of 2%. So 2% basically means that a building has a lifetime of 50 years, right? 100 divided by 50 is 2%. Now, what they've done is they've basically taken this 2% and they've increased it. They've increased it firstly for all new builds. So all new builds built between 2023 and September 2029 will get a 5% degressive depreciation or 3% linear. So the difference there is simply how you calculate the depreciation base. 3% is basically linear. So that means that the main amount that you're writing off from always stays the same. Whereas if you were to do degressive, you would decrease it by a smaller amount every single time. We'll show you in a second. But what they announced in 2024 that was especially interesting, and what the reason is behind InvestFriend actually, is that we found this special double depreciation of 5% linear to be extremely interesting. So it's almost too good to be true, and that's also why we've jumped so hard at it, because it's changed the whole formula, and we're quite fixated on numbers and formulas. And now all of a sudden this special depreciation has changed this whole thing. And we're going to talk about that in a little bit. But for special depreciation to work, we do need a number of criteria to be fulfilled. The first is it has to be the highest energy efficiency. So that's EH40, so energy efficiency house 40, QNG plus. It's basically a seal of approval. It means that this house has a very low energy consumption, 40% of the base. Secondly, it needs to be constructed under 50 to 100 euros. And now the calculation for that is a little bit more complicated because it's you have like a living space versus total space. So in total, including acquisition costs, you have to be around the 6,000. Why is that important? Because Telto is actually around 5,800 or 5,900 and it's still eligible. The last criteria is the building permit cannot be older than October 1, 2023. So this is the three criteria that we look at when we get new projects and new project developers who come to us and ask us for support. This is the three criteria that we use to justify whether it's special depreciation or not. And then this is always double checked by a tax advisor. So to kind of explain how the special depreciation works, we take this graph and I'll explain it to you. I'll try to make it as simple as possible. So you have a property price of 250,000 euros. You have a so-called building value of 212,000. It's important because you can't depreciate the land. And back when I said why the land value ratio to building value is so important is because you can't depreciate the land, buying in Berlin at 4,000 euros and then having the total being 8,000, you can only depreciate the 4,000 part. So when we look at the depreciation amount, we start at the 212,000. Now, what we call the accelerated or special depreciation is only in the first 4 years. So in the first 4 years, you have the special depreciation and the degressive depreciation. So you're basically depreciating till the end of 10 years, and here you've depreciated 52% of the total building value. So 102K you've written off against your taxes. And I'll explain how that kind of tax is calculated. But what's most important is, just like you have a laptop and you have a curve and you say, okay, my MacBook has a life span of 4 years, I would depreciate it by 25%. That would be 4 years, 25, 25, 25. Here you see basically 10%. It's a little bit less because the degressive, as I said, it's changing. And then at a certain point, actually the 3% linear makes more sense than the 5% degressive. That's usually, I think, at 8 years. Anyway, for the simplicity of this graph, we've shown what that depreciation would look like over the 10-year life cycle. After 10 years, in Germany, you can sell the property without capital gains when you're renting it out. So how do you actually calculate the tax savings, right? Because that's what a lot of people are interested in. It's great, you can so-called depreciate 52%, but what does that actually mean? What is it worth? Well, I'll give you a little example. So if we depreciate the 52%, so in this case it's the new value would be 102. So we've depreciated almost 100, let's just say 100K. So when you depreciate 100K, what you then do is you take your marginal tax rate. So let's say 40%. So we'll go into that in a second. So marginal tax rate is here. In Germany, you have a very strange tax curve because you have your tax rate plus solidarity. and it's actually higher for a lower income bracket. But typically, most people in this call will probably be around the 40%, right? So it starts around there, and then here it's all, it's all fixed at around. So you have your 42.5, and then you add your either 5.5 or 11.5. So typically at 40%, you'd be at, what did I calculate? So what did I say? 100K times 40% is 40K. So in this example, quite simple, you're basically at 40K tax savings for this specific unit of the 250K. Now, why is that interesting? Well, obviously two things. The first is the higher your taxable income, and the higher your tax bracket, the higher your marginal tax rate, and the higher your tax saving. We show that by calculating the same property with special depreciation across 3 income brackets. So 300, 100, 50, and you see that in the first 4 years, you're basically getting between 40 and 50% of your total tax savings in the first 20 years, you're getting back up front. And the reason why they've done this in such a way is that investors are then incentivized to basically invest in the new build projects as they get built, and then as soon as they're built, they can start depreciating and writing off, so that they actually get their cash back relatively quickly. And so you're not just buying one, but typically you buy one a year or 2 a year. So this is actually something I have to say was pretty well thought through, because it's a major incentive and it helps investors actually structure their cash flow in a smart way. So what else? What else changed in 2024? Well, you probably know that you have KfW programs. KfW programs are for both own use but also investment. So the 261 is for Denkmal, and we won't talk about that today, but there's, you have new build Denkmal as well, which we can, if there are questions about it, we can answer them. But primarily the key for for KfW is the program 298, which is funding for energy efficient properties. And it's again very attractive, not because it's 150K, not because the interest rate is 2.88, but because you don't have to repay in the first 5 years. And we will show you the little monthly cash flow model. But basically, imagine you get your tax benefits primarily in the first 4 years, and you don't have to pay the bulk of the loan in the first 5 years. You're basically in a very cash flow positive first couple of years, and then only there's a cash flow loss. So that allows you to recycle your equity investment. So basically what it means is there's a double whammy here, that you're with slow repayment and high tax benefits, that you're able to actually deploy your cash in a very efficient manner. So just to summarize, because this is something we get asked a lot, we have the benefits of being a landlord in Germany, which is selling without capital gains tax after 10 years. This is on a European level, this is very interesting. There's also no wealth tax, right? The second is you have your depreciation. In most countries, it's only 2%. As we just explained, it's up to 10% now. And the interest is also tax deductible, as are the purchase fees. So very interesting. You then have your KfW funding, which allows you to basically finance at a more attractive rate, but also preserve your equity by having a very low repayment. And the fourth is you have a very stable renting environment. So first of all, average tenancy is 8 years. Second of all the OECD countries, Germany has the lowest eviction rate of 0.4%, which makes it, from a landlord perspective, relatively hands-off and stress-free, so to say, especially when you have a property manager in the middle. Now, obviously, you have challenges of being a landlord as well. So you have a couple interesting regulations that you have to maneuver, so to say. So you have the rent cap. This basically caps the amount you can increase your rent on an annual basis. This is between 15 and 20% depending on the Bundesland. So Berlin is 15%. That implies that over 3 years you can increase it 5% per year, which in my perspective is not really a cap. It's just to slow down the crazy rent increases. Then you have the rent break. So for new leases, for existing properties, rent can be up to 10% above the local rent index. Now, the combination of these two in highly regulated areas, and today I posted something in Telegram, makes it very difficult to make properties cash flow positive in regulated areas like Berlin. Why? Because first of all, you have this Mietpreisbremse. The second is you have your rental cap. So it's quite difficult to then have a attractive cash flow project. So you then, and what's been happening a lot is you then have people who are switching to furnished rentals, who then add a surcharge on top for the furniture. So you rent for 12 euros per square meter, but because of the furniture, all of a sudden it's 18 euros, which is a loophole which is now being closed, especially in Berlin's Milieuschutz areas. So that's something, if you're doing this, be prepared for what's to come, because that might not be so safe for the next 2 years. Lastly, you have the strong tenant laws. And the fourth is you have high future energy efficiency requirements. And so when you look back to that graph where it said, the discount per house apartment over the energy efficiency types, well, the lower the energy efficiency class, the higher the discount rate, right? Because by 2030 we have to have a minimum energy standard, and this is, it might mean upgrading your heating system or your your windows or floors, insulation, etc. We're about 3 minutes to go. I'm almost done with my talking, and then we can jump around a little bit in some demo stuff. 3 pillars of real estate. Don't just build on tax benefits, that's for sure. You also need to look at appreciation and rental yield. Appreciation is primarily, as we talked about, very population specific, so location specific. So you have to find an area that's growing. And that's why we look at areas where the population is growing, which is close to areas that are growing more than other areas. Then you have rental yield. This is again typically a supply and demand. Where is the supply constrained? Where is demand increasing? Is it close to AWS, data centers, Tesla, whatever? This is very important. This is very clear. You have to look at the demographics. And then last is tax benefits, which we've talked about. From a new build perspective, more interesting than existing build at the moment. So final question, should you do own use or should you do an investment? Well, when you look at the comparison, appreciation depends, rental yield depends. Most important though is when you're in a rent protected apartment and your real cost is like 1%. So if you were to calculate your cold rent, multiply by 12 and divide it by the purchase price, and you get something like 1%. So let's say you're living in a 100 square meter place and you're paying 600 euros a month, you're obviously not going to give that up. So then the investment where you can get 3% or 4% return rental yield is of course much more interesting. Then you have depreciation. So when you're using it for your own for yourself, you cannot depreciate it. When it's an investment, it's up to 10%, as we just discussed. Capital gains, own use, it's after 3 years, there's no tax. In investment, it's 10 years. KfW, you have KfW 124 for own use. It is 100K, it is 3.5%, and you can also not repay in the first 5 years. But the investment side is more interesting, with the 150K and the 2.88%. So that's a side-by-side comparison. You can use our calculators where we basically do this and you can play around with the numbers. Bottom line is, if you're living in a rent-protected apartment or you cannot afford your home, so let's say you'd only move if you can afford a 150 square meter place, then buying 2-3 apartments for investment might be the smarter choice. Now, obviously we've done a lot of calculations and a lot of numbers. We have a very nice spreadsheet, but we've converted that now to a real estate investment calculator. It's here, so you can just click on the link, or maybe I can copy it in, or maybe Jan can copy it in, and then you can play around with it. This is an overview of our 4 projects that we still have. A number of them are Köpenick. I think there are maybe 3 or 4 units, but just very big ones. Teltow, I think there are 30 something units left. And in Solsen, we are now down to the last, 20, 30. These are both double depreciation Teltow as well, higher entry price, lower entry price. If you're interested in these and the calculations behind it, you can definitely reach out to the team. They will will run the numbers for you. I see some